Well, hello, it's Ken Himmler again, and thank you for joining because we had a busy year in 2024. Some good, some bad, but I wanted to kind of go through some of the things with you. And here's a real quick note for those of you that are clients of ours in Las Vegas. I'm going to be there on the 28th or the 29th and 30th, and we are going to be scheduling some meetings, not meetings, but seminars and some updates to kind of give you an insight on what we are going to be working on in 2025 for you. And this will be a chance for you to come in and meet some of our team members. We're going to have some team members, about 6 or 7 of them, flying in from all around the country. So look forward in your emails. We're going to have some invitations that are coming out pretty soon. And most likely we're going to hold these over in the Summerlin area. It looks like about 90% of our clients are in the Summerlin area. The other 10% spread out. But who knows? Vegas is getting so big right now, it could be anywhere at this point. But anyway, look forward to those invitations coming out soon. And let's talk about today's agenda. Now, before I get started, I'm going to go fast and furious because you're on video, which means you can change the speed of how you listen to it, and you can stop it and you can replay it. So unlike a live seminar, I'm giving you the opportunity here that you can make sure you're really absorbing the information, but in the context of time. If you're like me, I usually, if I'm listening to an audible, I turn the speed on to X because I like to listen to it quick. So you have the opportunity to slow me down or just listen to me at normal speed, which apparently from what I've been told, it's still pretty fast. All right, so let's talk about the agenda. So we're going to talk about the portfolio changes for 2024, the new administration changes, which will have a huge impact on our economy. We're also going to talk about what happened with the tax department and our new partner, Aspire Tax and Accounting. We're going to talk about the changes that we're making within the asset management department, as well as why did we change our name? That's the big mystery, why everybody's asking and calling in and emailing. So I thought, hey, it's probably better just to put together something where it makes just a lot of sense as to why did we do that. And then the teams and communication, as well as I'm going to give you my assessment as to how did we do in 2024. Now, we've sent out a lot of surveys. We've made a lot of phone calls to a lot of clients just to get your feedback. And your feedback is important, but I may be more critical on my scorecard than the responses that I've seen come back from our surveys. So here we go. All right, let's talk about the investment changes for changes. Well, what did we do in 2024, and what are we looking forward to in 2025? So, in November of 23, we started seeing the writing on the wall about interest rates coming down. So what did we do? We moved the funds that were in, not all, a percentage based upon the model that you're in. We moved a big percentage of the short and intermediate term bonds to long-term bonds. And let me tell you, that worked out well. As the interest rates started going down, the long-term bonds actually gained in value, while those participants in those longer-term bonds enjoyed a much higher rate of return because they're longer term, which means that they're going to be paying a much higher rate of return. Now, we did that throughout November, December of 23, so we had that experience of that positive outcome the entire year of 2024. We did it also inside of rotating ETFs, and that really proved to be a lot less risk than any individual issued bond. And it also allowed us to start cranking up because as the bonds in a rotating ETF come due, if it's call it a long-term bond ETF, then they have to rebuy long-term bonds. So we were repurchasing them at much higher interest rates, which is also a benefit because in the next year to 2 years to 3 years, as interest rates start to come back down again, those long-term bonds have more potential for gains than a short-term bond, in addition to earning the much higher interest rate during that interim. What about the stock portfolios? Well, here's what's interesting. Last year, the S&P cranked out a 23.3% rate of return. Some of you in our portfolios, you did actually much better than that. Some of you that were trying to tamper down some of the risk were somewhere near or a little bit below that, but the key was your risk was much less because of the diversification that we're using into multiple asset classes. That risk is measured by volatility was much less than just the S&P 500 fund. So our number one goal is to manage your risk because we believe, like Warren Buffett says, that his three rules are don't lose money. Number two is don't lose money. And number three is see number one and two. Kind of like that old idea of location, location, location for real estate. But our number one goal is to reduce the amount of risk. Now, with that, again, when the market tumbles and you see 20, 30% down, everybody's happy. They're like, gosh, you guys, thank you so much for not putting me into that kind of volatility. Now, the flip side of that is when the market goes way up. Now we have a lot of people with FOMO. They think that they missed out on something. They look and say, well, the S&P did 24 and I only did 14. Well, that might be because you are in a particular model that we are distributing cash from. And we have reverse engineered that portfolio to reduce the volatility, the ups and the downs, in sections, we call them buckets, so that we don't take that kind of risk on. So in the down years, you are less risk. In the up years, you of course are not going to capture the full upside of the market. That's the trade-off. Now, this is a good opportunity that if you looked at this year and you said, you know what, maybe I did miss out on some of the upside and maybe I'm willing to revisit that again. That's the time that you're going to discuss that with us in February and March, which little new secret change coming up here pretty soon, which I'm going to explain to you. And this will be an opportunity for you to actually maybe look at what it would look like in a higher growth portfolio, but we'll help you understand and measure what that downside risk is. Okay, in 2024, I saw this incredible amount of questions, comments, emails that were coming to my team, and I thought, I have to address this. And I know we addressed this when we originally set up the plan. But if you're anything like me, you tell me something today, and if I'm not revisiting it probably every 2 weeks, the older I get, the period gets shorter, right? So if I'm not revisiting it, I forget about it. And so I think what had happened was we got some clients that called up, they emailed in, and they were upset. And they said, listen, you know, my Roth and my non-IRA, man, they are so outperforming the market. But my IRA, its performance is terrible. Not all of you, because if you are in a higher model, meaning our models run from 1 to 6, and you're in a higher model, you 5 or 6s, because there's very little in bonds, then you don't really see this effect. But if you're in a lower end model, meaning not lower end, that's the wrong term, lower risk model like a 2, 3, or 4, there is an allocation towards bonds. Now, the tax outcome of a bond is not friendly, meaning that if you have a bond, it produces ordinary income. And that is never good inside of a tax plan because you're going to be paying the highest tax on it. It's not capital gains, it's just ordinary interest. Inside of an IRA, if the IRA holds the bond, that interest doesn't show up in your tax return each year. And that's the downside of a bond being held in a regular account, is that whether or not you spend the money, that darn interest is going to show up on your tax returns every single year. So what we do to minimize that is something called location optimization. All that simply means is we take your portfolio, and in a perfect world, if somebody came to us and said, okay, I got $10 million, I want a 50-50 portfolio, 50% stock, 50% bonds, and oh, by the way, I just happen to have an IRA with exactly 5 million and a non-IRA with exactly 5 million. Well, that's easy. We just allocate 100% of the bonds in the IRA and 100% of the stock in the non-IRA. Now, why do we do that? Well, because when you put stock in an IRA, it gets double taxed. The tax rate on profit coming out of an IRA is ordinary income versus capital gains. Now, you've watched any of my videos on YouTube lately, you know that you can earn over $80,000 a year, and your tax rate on capital gains is 0. You can earn up to $400,000, and your tax rate is 15. Now, if you have ordinary income tax at $400,000, you're going to be about 35 to 40%, and that doesn't even include if you have state income tax. So the summary is we try as much as possible to stack the lower performing investments in the IRA. The second reason for this, which is a lot of people don't consider, the sales pitch by the big boys, the big 401ks, the big custodians is, save in your IRA because it's tax deferred. Well, the bottom line is if we buy stock, it's tax deferred naturally. We don't need an account. The problem is if you put stock inside of the IRA and now you've doubled your money because bonds maybe will make 5 or 6%, whereas as you saw last year, the equity markets made 23, almost 24%. So if you doubled your money in the IRA, guess what else happens? Your required minimum distribution doubles, and that is also fully taxable. So I want you to keep in mind that we're not failing on the job. We had some clients call and say, this IRA is terrible performance. What are you doing with this thing? Well, we have to log them into eMoney. We have to show them their bucket strategy. How much did they allocate to bonds? We have to show them that the bonds were allocated to the IRA for tax reduction strategies. So when you look at your performance per se, you're going to use all of the accounts together because we'll even do location optimization with a Roth. So if you have a Roth, we're going to put those high growth stocks that have the highest potential in the Roth because it's 100% tax free. If there's dividends, we might try to stack on stock. We might try to stack that inside of the Roth so the dividends are tax free. Again, I'm striving for a completely, now I don't always get there, but I strive for 100% tax-free outcome for every single person. I'd like to say I can do that, but depending upon how you come to us. So as an example, if you wanted 50-50 stock bonds, but you had 200,000 in a Roth, and you had, what did I use? 10 million, let's use a million so I can do the math easier. So you got $1 million and you got $200,000 sitting in a Roth and you got $300,000 sitting in an IRA and the other 500,000 is in your non-retirement accounts. I can't slice and dice. None of us can slice and dice that down because you're limited to the efficiency of location optimization based upon two factors. One is what is the model you choose, because that dictates the amount of stock and bond mix. Two is what are the account balances. So we do optimize as much as we can, but there's no perfect world. As I said before, if you came to us and I got $10 million, I got $5 million in my IRA, $5 million in my non-IRA, and I want 50% stock and bonds. Easy, piece of cake, but I've never seen that. So hopefully this makes a little bit more sense. How we allocate between IRAs, Roths, and non-IRAs. Now, again, we want you to really work with us and log into eMoney, look at your asset investment report. It will show you the amount that's in each bucket. Now, if you don't remember how to do that, email in to your team and they will schedule a time and they'll walk you through it right online. Okay. In summary, you shouldn't be using a single account, meaning don't look at one single account and determine the performance on that one single account because that's not how we're doing it. You have to look at what was the average performance amongst all of the accounts. All right, election, here we go, new administration. We're not going to get into politics. I know a lot of you want to, but we're not going to do it. We're only going to talk about the economics of each of the administrations. All right, so let's take a look at the strategy for 2025. Well, when interest rates started going down, they did not go down as quick as anticipated. So it's going to be a little slower burn to get where we want to go. What does that mean? It means that we are going to be holding those longer term bonds for an extended period of time. As the rates come down and we feel like they bottom out, that is when we will move from the longer term back to shorter intermediate term, because when rates are at, I don't want to say the bottom because no one knows what the bottom is, but they're at the realistic low level, then you take more risk by having the long-term bonds. So that's what we follow for you, is that ebb and flow of how to move that based upon interest rates. Again, that is not crystal balling. It is not market timing. That's a simple number that you can follow that relates to the risk and the returns on the bonds. I get a lot of questions. What about the war and geopolitical? Listen, if you watch that Time magazine video that I did 2 years ago, right when Russia invaded Ukraine, if you hadn't, email into the team. We'll email you a copy of that video because I got such great feedback on that, such as I had no idea. What I did was I took every month of Time magazine for the last 50 years and I showed every world conflict. And it's easy to get caught up in the moment of what's going on, especially if you read 5 news articles. Honestly, there's nuclear war going to happen on Monday, and then the Earth will get hit by an asteroid on Tuesday, and then the galaxy will go up in smoke on Wednesday. I mean, this is what media does. They have to attract you to read it. However, when we really look at the economics, I think that where we are right now with war and geopolitical issues is that we're in a neutral zone. However, what has happened to a positive is that a lot of where the concentration of risk lied before has started to disperse or dilute itself. Meaning China throughout the pandemic and now the war. So China is starting to lose its manufacturing edge. That's good. We want that diversified because the more that they can control, the more they can hold the rest of the world in handcuffs, just like they did during the pandemic. Let's not forget what they did, right? So also with Russia and their oil, and now that we have a different administration, there's arguments such as, well, bring back oil and fracking, but we were one of the biggest producers that there was. But some of the problems wasn't just the amount of production, it was the cost and regulations and overlay that the past administration was causing. Thereby, you've seen your gallon per gas price drop, and it will probably continue to drop until the next administration. Now, if you think through, why is Warren Buffett just going all in on Occidental? Because he knows that if they can lower production costs, then it's not that they're going to raise the price of oil, but they will be more profitable. So that's the good news. So we also look at BRICS. BRICS was a big concern of mine about 2 years ago. And if you don't know what BRICS is, it's Brazil, Russia, India, China, and South Africa. And they were trying to collude together to come up with a alternative currency that would bury the US. It fell apart. I'll state this again if you haven't heard me state it before. While other countries want to be us, they can never be us because they don't have the culture of us. We outwork every single country in the world. Well, we are now. If you study the fall of Rome, you'll know that as they started cutting down work weeks in Rome, as they started giving benefits, as that kind of culture changed, Rome fell apart. So right now, we are still the world leader with currency and economies. We work harder than anybody else. We spend more than everybody else. We have the superior banking system. We have the superior Wall Street system. We have a superior regulatory system. While I don't agree with what happened over the last 4 years, and the regulations, at least in my business, have quadrupled, but we still have the far superior system compared to anywhere else in the world. So BRICS tried to take us out. Didn't work. Why? They're not us. They don't have our culture. They don't have our banking system. So the world got nervous and said, yeah, you guys got a great idea, but you don't have it set up. So that risk for me is really off the table at this point. Real estate. If you watched my last econ update in November of 23, my predictions were that at the beginning of 24, we would start to see a lot of real estate drop. Did not happen. That was not, my prediction on that was 50-50. It did in the last quarter of 24, but that interest rate spike takes a little bit longer to gestate in the real estate markets than it does in the bond markets. Bond markets can be daily and 6 to 9 months. I thought I planned out pretty well, but a lot of this doesn't have to do with the portfolios that we manage in as much as the investment real estate that I own and that I was looking to purchase, and that what we were discussing those things with certain clients that are in that space. So unfortunately, it's because all the government handouts really reduced the amount of risk. But that has to come home and to roost sooner or later too, right? You can't just keep giving out money, i.e. the close to $40 trillion that we are in debt now. So what are we doing going forward in strategy of 2025? Well, we have taxes and regulations, right? Taxes and regulations are the big issue that we're facing, and we know that by reducing some of the tax and the regulations, companies will come back to the U.S. That will increase our GDP, gross domestic product, it'll increase our cash, it'll increase jobs. So I'm looking for an incredibly robust economy in the next 4 years. This has worked in the past. Every time it's been employed where you make business friendly, you reduce taxes, you reduce regulations, guess what? People want to go there. Just like all these people from New York and California have moved to Texas and Nevada and Florida. They want better lives for themselves. Heck, why did everybody leave England, right? They didn't like that economy. People were poor, they couldn't eat, couldn't afford to feed their families, so they came to the US. This is no different. So I believe that this position that this administration is taking is a positive one. They're attempting to reduce C Corp, corporate income tax rates, all the way from 21 down to 15. Now, a lot of people think, well, how are they going to pay? Listen, there's this thing called velocity of money. Velocity of money says that when you lower taxes, people spend more. If you take one tax dollar that the government collects, but you give the dollar back to the taxpayer and they spend it, it turns into $3. And why? Because whatever you're spending it on, those people are paying taxes, those people are paying employment taxes, and then they spend it somewhere and they spend it somewhere. Again, that's called the velocity of money. So I really believe that by lowering those corporate income taxes, that will just rocket fuel our economy in the next 4 years. The last piece is the estate tax. Now, for most of you, you didn't know that we only have this year, and then next year, the law states that the estate tax limit will go from its current almost 13 million down to 5.6 million, which is what it was in 2015 before this whole law got passed. We don't know. We have no idea. Now we know that the Republicans control both sides of the aisle and the presidency. So there's the high probability that this tax reduction will get extended. But again, every 4 years, we got to play a new game. That's what keeps my life exciting. Never a dull moment. Now, the last piece in this, and regulations we're talking about, is the BOI, beneficial owner of interest. And this was a form that was mandated. So if you have, or we have set up for you, an LLC to protect your assets, the government said you must file this form by December 31st. Otherwise, you face $570 a day in penalties and up to $10,000 in total and 2 years in jail. It's pretty serious. And again, this last administration, 400% in regulations that they increased. However, just recently, the Fifth Circuit Court of Texas, this has been going back and forth in the courts since September 1st. There was a stay, and then the stay was appealed and amended. Then the stay was reinstated. Right now, where we stand, as of the shooting of this video, is the stay, which is not a kill the law. It is, we're going to evaluate this, is on hold. However, if you didn't file your BOI, we tried to file it for as many, it was like mad rush at the end of the year. If you haven't filed it, you still have until January 13th, 2025. If you haven't filed it with the anticipation that the government's just going to do away with it, I think that's a very risky proposition, because if they bring it back in, you miss the filing date, you're going to be subjected to those penalties. Well, let's talk about the IRS, because I think this is going to be the biggest risk that we have going into 2025. I don't believe it's the economy. As long as we have listened to what your cash flow is and we have designed and reverse engineered your cash flow, I don't believe we have that big of a risk if we're overseeing the funds we are in the economy for you in 2025. The biggest risk is with the IRS. This is something that it's not just me. What's funny is about 2 years ago, we had a client get one of these very threatening letters from the IRS, and it said, you owe us $150,000 in a penalty. It's basically because, as a short story, we sent in 40 what's called 5,500 returns. Now, these are done on LLCs for pension plans. And just like you've read about these stories where the postal guy throws the trash in a dumpster, or the Amazon delivery guy gets stressed out, so he leaves all the packages in the woods. I mean, I'm sure you've seen this in media, right? Well, apparently the IRS is doing the same thing. So we sent all 40 in one package. They recorded 5 of the 40. I think there was actually 42. 5 of the 42. Now, we sent them all in a certified mailing package. Who knows what happened to the other 30 plus? They just disappeared. Then those clients get this threatening letter. So I had one client, called me, and he was obviously irate because, you get a letter saying from the IRS, you owe us $150,000 or we're going to start seizing your property. Of course, you have the right to be upset and stressed out. No doubt about it. However, when I explained to him what was going on, that we had contacted the IRS, and here's what his response was. Ken, you're always blaming the IRS. I said, well, if it's our mistake, we'll take responsibility. But the bottom line is, this is not just me. Every CPA I know, every EA I know, and all of the financial communities, this isn't just us. This is everybody in the tax community is facing this with the IRS. And it's a problem because, and this is where I will tell you, I was wrong. I was so far off. When I saw in 2021 technically, that the IRS was going to get $80 billion and they were going to hire 80,000 new employees. I know this sounds ridiculous, but I actually, and there's video proof out there that you can go on YouTube. There's like 120 videos there. You can go back and where I stated this on video, and I said, I know everybody's going to hate me for this, but I'm kind of glad that the IRS is getting more money. Not that it's going to increase audits, because then they'll have more money to go after just the everyday Joe. But when we were on the phone with the IRS, and literally, I don't say that my team complained to me about this. This is me. I actually was arguing with the IRS on a charitable remainder trust. And so I called them. I'm on hold, no kidding. 3 hours, then they hang up on me. I call back. I'm on hold for an hour. Then they put me through the charitable trust department. And I get a message. This number is no longer in service. I said, you got to be kidding me. The entire department was shut down. So clients look to us to try to fix IRS problems. But sometimes we can't. Now, the going forward and what we see in 2025 is, and I'm going to freely admit, I was so wrong believing that money would have fixed the problem. It didn't. As a matter of fact, I think that it's a lot worse than it ever was, because if I look back in the last 2 years, and I was actually a recipient of one of these audits, so the audit was, they audited one of my companies in order to train a new person. Cost us about $20,000 in time and effort. They didn't find a single thing, didn't have a single penalty, but they sucked up our time just to train somebody else. I warned about this 3-4 years ago, and it happened to me. I've also been warning people about all of these mistake emails or letters. I got one not too long ago. It said, Ken, you owe $43,000 in income tax for a quarterly payment. I said, wait, that was paid. So after 5 hours, we fought it, and they said, oh, yeah, sorry, we applied that to a different company. Yeah, let me correct that for you. So it's not just you that is going through this. It's me and every other tax professional. Anybody in the U.S. tax system has gone through this. So our internal estimate is that audits have gone up 200%, and tax notices, incorrect tax notices, have gone up 300%. I don't know or understand how this could possibly happen when you have all these new employees, you have all these new phone systems, you have all these new computers, yet it's worse. Well, these are the common mistakes that I'm seeing. They're applying credits to the wrong years. They're not applying credits at all. They're just losing the data. Or the lost forms, like what happened to us, where they opened it and it was certified mail. And here's what the agent told me. Well, I can't take that. Here's what the agent told the person in our office that called them and said, well, do you have proof that you included all 40 some of those? No, we don't. So what do? Take a picture with a video of proof of every time we do something with the IRS? A little ridiculous, I know. So we have to be very careful going into 2025, and at least for the next 4 years, because we saw this the last time Trump was president and he defunded the IRS. It just causes havoc. Well, I shouldn't say that. They gave them $80 billion and they got worse. So they're going to get defunded as much as they possibly can. So the estimates that we have on tax notices and problems with the IRS are only going to increase. So what are we doing to offset this? Well, we had to look back and we had to say, we don't want to come back to you and double our fees for doing tax returns, because we have to add in all these additional staff members. That's not fair to you, but we want to be able to handle these things in an appropriate manner and fight with the IRS on your behalf. So what we've done is we've now partnered with Aspire Tax and Accounting. Now this is owned by Sean Williford, who is one of our tax people that had been with our firm now for a year. He owns that firm. And in 2025, we're going to have Sean, Brian, and Jean Christopher still being the preparers. Sean is actually backing up. He's now in the process of hiring additional people in the anticipation of all of the bad IRS notices and arguments that we're going to get into with the IRS. So here's the deal. We will not increase prices for anybody that is under our wealth management agreement. So we are still going to give you the discount, meaning that if you're in level 3 and you get a 25% discount on your tax prep, we've negotiated that with Aspire and they're going to honor that. So there's no increase to you. So in a sense, what I'm doing is, instead of coming back to you and saying, hey, we have to increase this to some ridiculous amount because of the IRS's issues, we're trying to rearrange the chess pieces on the board in order to not charge you more, but still be prepared for all what I consider is going to be a waterfall of problems. So again, why do we go with Aspire? Well, they have more staff. They have a very experienced tax manager, and we are totally expecting twice the amount of audits and twice the amount of tax issues. And that team is going to be dedicated just to tax, not anywhere in the other ethos. Yes, they will still be in our communication channel. We can exchange information back and forth. We've already set up the tech stack where if you contact them, our financial planners will be communicating with them on a daily basis throughout tax season. So it's still, everything's under one roof. It just happens to be that we're bringing in some backup to what we do, okay? Being prepared for 2024. We're going to be sending out tax planning. We're going to be scheduling, let me put it that way. We're going to be sending out a tax planning questionnaire to you, but we're going to change it up this year, because what we found is that a lot of you are procrastinators and you wait until April 14th and you call us up and you go, hey, I'm going to drop off this shoot box of stuff and can you have it all done by tomorrow? Well, with 600 clients that we do tax returns for, that gets a little cumbersome and we can't always meet your expectations. So we're going to hedge that this year a little bit. Now, for those of you that get everything in, thank you. We appreciate you. For those of you that wait until 11:50 on the day before filing, we're going to try to help you through that process this year. And so what we're going to do all of our financial planning meetings. So we're going to break up our meetings into 2 segments. It's now going to be February and March, and we're going to do your cash flow planning, your required minimum distributions, your Roth calculations, and all of your income tax planning so that you are making the right amount of estimates to avoid penalties. We're going to do all of that in February and March. Then we're going to do it again in October, November. So while some of you were used to the quarterly meetings that we would do, we're finding that we're not getting the tax plan done in enough time to take advantage of all the deductions. So we're going to change it to February, March. We're also going to be, again, performing that second analysis in October, November. Now, here's the great news. We've just invested a lot of money in a brand new AI tax software program. Now, what this does is it's going to take thousands of iterations of what you can do to reduce your tax. Now, so you understand, because I'm sure you're going to see this on our website and some other places, when we're doing this for non-managed clients, the fee to do this is $10,000 per client. If you are under our management, you will be getting that service 100% free. No cost, no additional hidden anything. We are going to do that for you. Anybody that comes to us new that is not under our management, that will be the fee to do that tax AI system. Now, I will tell you that in the test and beta testing that we were doing with a software company, when we run this on somebody that has at least $1 million in their IRA, then we save double the amount of the fee. So it's a no-brainer. It's a 100% rate of return in the first 12 months, and then you continue to save that amount of money every year thereafter. How about the asset protection? We have to make some changes in the asset protection department. What are we going to be doing? Well, number one, we're going to stop the TAP. That was the trust amendment package that we came out with in 2020. Now, I did get some very positive feedback. About 80% of our clients said this is the greatest thing. 20% of them pushed back and said, well, I actually had some people say, well, you're just trying to make more money. I said, no problem. Don't sign up for it. Listen, for the amount of money we're charging for this, it's not going to make me or break me if you do or don't sign up for the TAP. But for those of you that did, it was costing about $400 per year. This gave you unlimited amendments, adjustments, anything that was going on with the tax law, the laws around the IRAs, and we had a lot of them, right? We had Secure Act 2.0. We had to rewrite everybody's trust from the ground up in 2020, 2021. Then they changed the rules on RMDs. Then they came out with Secure Act 2.0 in February of 23. We had to redo it all over again. So when we went back and we analyzed what we were charging versus the amount of labor, we were losing money. So some of you said, well, I don't see any value out of this. Well, that's because you're not paying to have a whole new trust redrafted from the ground up. So when we're spending, and listen, I would love to continue to offer this, but if we don't at least break even, then we're not in business to serve you any longer. So we have to cut out some of the things that we're losing money on, and one of those is the TAP. But we will still have the availability that under new tax laws, new IRAs, you can still come to us. We will redraft based on an hourly fee, not a flat fee. This way it will accommodate those of you that need a lot of work, but those of you that don't, you're not paying a lot. And that's what we were finding with the TAP. Some people would come in and they'd pay us $400 and they'd burn up $4,000 of labor time. And then there were some people that were paying the $400 and we'd get it done within an hour for $150. So we're going to just change that so it's fairer to everybody. In addition, we also want to make sure that you understand that you still can come to us. And I like this and I want to offer this because what I have found in 40 years is when people draft a trust for you, they look at it more like a transaction, like you buy a car, right? Well, even a car, you need maintenance. That's probably a bad idea. I don't know, a piece of jewelry. So you buy a piece of jewelry, it's a transaction, you got the jewelry, there's not much else to do with it, right? So we know that a lot of you have trusts, some lawyer, some doc prep company has done it, and it just sat there for years. Just because you have a trust does not mean it's A, valid, B, it's up to date. So we got to make sure that we're keeping it up to date. And so going forward, we will do away with the TAP. Any of you that are in the TAP right now, I got mixed feedback from the team. I've just decided I'm going to grandfather it in. You can continue to buy it. We'll continue it. We just will not be offering this to any new clients. And if you got out of the TAP, unfortunately, we're not allowing anybody back into that. How about custom legal documents? Well, a lot of you are coming to us and you'd want a loan agreement, or you would want a transactional agreement, key man agreement, exit strategy, business sale agreement, whatever it is. So we're going to try to reduce the amount of work. And here's why. As we know, inflation right now in the last 4 years has gone up close to 35%. And we have not increased any of our fees as a percentage. So if we are to employ really competent people, we would have to substantially increase our fees to attract that talent. And since custom legal documents are really not our mainstay, it was done ad hoc, we are trying not to increase any fees. As a matter of fact, the fees that we have now on our trusts and our entities are the same as they were 8 years ago. We haven't increased those fees, and I want to keep it in an affordable zone. So in order to do that, we got to get rid of the custom documents. And what I'm talking about is we will continue to draft family trusts, asset protection trusts, whether it's a DAPT, a NAPT, whatever it is, a basic self-settled asset protection trust, a charitable trust, family foundations, including nonprofits. We'll still draft those for you. Corporations and LLCs, life insurance trusts, custom pension and retirement plans, but we will no longer produce custom legal docs. However, I know a lot of you have depended upon us to kick those out, and I didn't want to leave you high and dry. So here's what we've done. We've contracted with a private company that offers paralegal services, much like we've done with Aspire Tax and Accounting. This way, if you have a custom doc, we'll be able to connect you through our license to a paralegal. That paralegal will be able to draft those documents for you at the same rate as what we would have drafted them for you for before. So there's no increase in cost, but we're getting a dedicated team that will be able to service you on just that regard. Okay, now the fun part. What about name change? Okay, name change. Well, why do we change the name? Well, we go back to this whole concept of what is financial planning? No one knows what financial planning is. And people have really abused this terminology. Like if I go to an insurance agent, he calls himself a financial planner. If I go to a broker like a Merrill, UBS, blah, 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 they're like, well, yeah, we're financial planners or we're wealth managers. But the problem is they don't really handle wealth. They handle investments, because ask them to review your tax returns. No, well, we don't do tax advice. Ask them to review your trust. No, well, we don't do advanced estate planning. Ask them to review your risk on your auto, your home, your umbrella. Create an asset protection strategy with LLCs. So, yeah, you got to go see somebody else for that. So when I think about wealth management, I think about everything encompassed, integrated together, working together, and cohesive. But the industry is unfortunately, they've stolen this word, but they don't produce what I believe is behind the word. And so when I talk about maps, that may be at least what I thought was, and I think so today, a map is a destination that you want to get to and the way to get there. So if I look at a map, I'm driving, right? Remember the old days, this is for you old people like me. Remember AAA, and they'd give you the little triptych. I know some of you younger people are going like, I don't know what he's talking about. It's like when you talk about a younger person about a movie, they're like, I never saw that, right? And that was 1990s, whatever. So you got this triptych. And you remember that what they would do is they would highlight the routes, and then they would mark on that triptych, hey, here's a construction, here's a speed trap. That's a map, right? But the problem is people will go and they'll go see an accountant. They'll get their accounting and tax map from them. Then they'll go see a lawyer. They have one asset protection map or one family trust map. Then they go see sometimes multiple advisors for finances, and they get all these multiple maps. And they go see the insurance agent. The maps are all over the place. Now imagine you're trying to get from destination A to B, and you got 5 different maps. Which one do you take? And do you overlay them? Sometimes they conflict, right? Because if you're doing something with one person, great example is the accountants, the tax people, right? They do not communicate with financial advisors in other firms. They send to the financial advisor what you paid in tax. Or in April, the CPA or the tax preparer is reaching out to the financial advisor and saying, hey, can you get me all the 1099s? That's not working together. That's just having an agreement. You're going to share information, but that's not proactively working together. I wanted a term that people could imagine. I take all those different pieces and I'm going to put them together into one single map. I'm going to take my investment and cash flow map. I'm going to take my tax planning map, my asset protection map, my estate planning map, my insurance and risk planning map, and my risk reduction strategies map, and finally my family inheritance planning map. And I'm going to combine them all together. So they're all working together cohesively with the least amount of risk and cost possible. Therein lies the reason for the name change. Hopefully, the name change encompasses what we really do. Now, let's talk about some things I don't think we did very well in 2024. We had some major issues with our email system with Microsoft. There was a lot of issues receiving emails, sending emails. We made a big move. Change always costs a lot of money, a lot of time, and it's usually wrought with potential for errors. So I don't take changes lightly. But considering the feedback I was getting from my team and from you, all clients, we made a big move in June. We made a move to switch from Microsoft over to Google, and that has worked out very well. Doesn't always, and it hasn't always, but this one worked out pretty well. The one question I am going to ask of everybody, if you go to the website, One Wealth Map, there is now a menu item in the top right called Suggestions. We want to know from you, what could we do better? And one of those questions I have is this. We set up a redundant backup system during the pandemic so that and it happened, right? One of our advisors at that time had a nervous breakdown. One of them had a medical issue and they had to resign. Another one just couldn't get into the remote world. So we have this issue that we're humans dealing with you, another human, and I could die tomorrow. I might actually want to take a vacation. Not right now, but maybe sometime in the future. And I might be out of the pocket for a little while, right? So we're humans, and I didn't want you to be under this old model of bricks and mortar. Hey, I'm calling to talk to my lady or my guy, and they're out for 5 days. So we created the teams. This way we had a backup system of redundancy, very much like the military, right? Thank you, Colonel Jaworski. That was great information you gave me back in 2020. I used it, appreciate it. Thank you again. So what I wanted to do is make sure that we had a backup system. And so here you see the email outline. What I need a suggestion on is can we just go to one single email? We have the technology now with Google that we could turn everything into one team at One Wealth Map. Might be easier for you, especially if you want to switch teams, want to switch advisors, whatever it is. There's always just one email. Now, right now, everybody's adopted the team emails, so we don't have a problem with it, but I am looking for some feedback. So if you have any suggestions, please just visit my website or the website, onewealthmap.com, and fill out that suggestion box, and I can evaluate what everybody's thinking. I think one email is probably going to be simpler than the team email, but I'll leave it up to you because you're the one that has to deal with it. So I will wait to see what those suggestions are. Phone numbers. We had our real issues with Vonage, and then we switched to Simply, Simplii. Both of them absolute nightmares, right? Both of them, as you remember, the call quality, because it's all internet protocol, IP phone systems, phones were getting a message dropped, the voicemails wouldn't work, the connections and transfers weren't working correctly. So I want to personally apologize for that. I wish I could have known, all you can do is read, how many ratings they have and testimonials, and sometimes those things are true, sometimes they're not. And we had to make a decision to move away from Vonage and move to Simply, and that was no better. So I'm sorry for any frustration you have had. Now here's the good news. Thank you to Anthony and Leanna. We appreciate you because you guys found our new Ring Central. We've been on this system now since about 4 months and not a single problem. So thank goodness, we appreciate it. That should now be fixed. Secondly is we had a phone tree and we got feedback, and this is from you, so I appreciate your feedback. We want to be better for you. So your feedback was, I hate it when I call in and I got to press 1 for asset management department, 2 for tax department, 3 for whatever. And so we've eliminated it now. What we've done now is our phone system will ring through to 6 separate people at one time. We want to talk with humans. Heck, I call a company. I don't want to go through all that mess. I just want to talk to a person and get it done. My time is more valuable, and it's frustrating. And so I'm sorry if we had frustration for you by having that menu. That's gone, never to be revived again. We'll have humans answering the phone. But it also means that if you call in and all 6 people are on the phone or they're helping other clients, sorry, you might have to leave a voicemail. It is not my intention to have you leave a voicemail. But right now, most people are saying they'd rather do that than go through that silly phone tree system and then still leave a voicemail message. Okay, so our scorecard. And again, this is not what clients responded to. This is my own assessment. And I assess this with so much criticism of how we do, maybe too much. That's just the way I look at improving. We have to look at what we're doing well and what we're not doing well. So let's go through point by point. Our portfolio returns, I think they were fantastic. When I look at the amount of risk and then what we earned in comparison to the indexes, I think we did fantastic. I give us an A+. The tax management of the portfolios, and this really goes out to our financial planners, working with you hand to hand, making sure that the moves that you're making within the portfolios are going to reduce tax as much as they can, whether it was tax swaps, tax loss harvesting, Roth conversions, QCDs, timed RMDs, location optimization. There was a lot of things that we did, and in a very positive way. I think we did great with that, and that really is a testament to our great financial planners. Tax department, I give us a D. And I say that because the workflow and the people that we had on that team were not up to my expectations. We have since let almost all of those people go in the tax department. The expectation that I have is if you call or you email in, I want you responded to within 24 hours. And if the task is not completed, I feel like we fail if you have to call us to follow up. So we have replaced those people with new people that have a burning desire to make sure you are taken care of. You're not having to follow up with us. Your emails are answered. That is what I believe would have made a much better tax season. So in 2025, I'm anticipating a easygoing, simple tax season. Asset management department, I give that a B. And the reason I give it a lower grade is that this was a fundamental problem with the TAP overloading the department. It was a fundamental problem with doing a lot of custom documents. And the time from engagement to delivery of those documents to you was far past my expectations. So what we have done is we've reworked that department by bringing in the paralegals, getting rid of the new TAPs, getting rid of custom documents. So the core thing that we're doing for you is quick, fast, and accurate. So I don't believe we did well on that, but we have made the changes to improve that. Financial plans and accuracy. Well, part of what we do is review the accuracy of those financial plans. And I know this is the creepiest thing in the world. Now, I've been using eMoney for over 20 years. It's so creepy how accurate that thing gets. It gets within about 10% of projections over 5 to 10 year periods of time. And for a financial program to be, if it's done right, if it's programmed right, I don't know, it's just a little creepy. Like that's scarily accurate. So I think the way that we created the financial plans and their accuracy was an A+. However, our communications and follow-up, I do not give us a good grade on that at all. I think that we failed in the context of, if I go to a Four Seasons, then I expect superior service. I expect to be met. I expect to have people make sure that my room is clean. I make sure that if I call somebody from the front desk, they answer. And I think we could have done a lot better. Now, again, part of that was our tech stack, but a small part. More of that was how would I say this with PC? The new culture, no matter where I go, is, yeah, I'll get to you when I get to you. Yeah, maybe I'll respond to you. Well, not my problem. And I'm sorry. Maybe I'm an old guy and I'm just not adjusted to the new culture, but that is not acceptable to me. We have now replaced those people. They are no longer with the firm. And we now have a core team of people that I believe have the number one quality to work in this firm, which is they care about you and your feelings, how you relate, that you are respected. And what I mean by that is if you call or email in, I expect that to be done within 24 hours. If that person can't do that, they don't have a seat on my team anymore. So hopefully we replaced everybody with people with those giant hearts that truly care about you. However, please don't always depend upon electronic communications. There is no doubt that they're great, but emails don't always get through. So the one favor I have to ask of you is if you email and you don't get a response within 24 hours, there's either two problems. One, I got somebody that's not responding. I need to know that, right? Because I will make the change because you expect the best. Number two, it could be something electronic. That happens, believe it or not. We just had a situation with a client where 3 emails went out, she got it. 4th email went out, she didn't get it, wasn't in spam. 5th email went out, she didn't get it, wasn't in spam. We have no idea where it went. It's somewhere in some other 5th dimension of email systems. So if you do not get a response, please call in and say, I sent an email, we can trace back what happened. That way we're always communicating on a better plane. Same thing if you upload a document, whether you're uploading it to the tax system for tax prep or you're uploading it to e-money, if you uploaded something, we should get notification. But again, nothing in the electronic world is 100% guaranteed. So if you're expecting something to be uploaded and action taken and you don't see it in 24 hours. Now, that means if you upload it on a Friday at 5 o'clock, that doesn't include the 24 hours. Give us till Monday and a day, right? But if you don't see it, call the office and we'll diagnose it. So the last, before I wrap up today, most of you know why I restarted this firm. I was retired at the age of 48 and I love what I do and I love working with clients. There is nothing more satisfying to me than figuring the puzzle out, improving your life, and seeing you live a better life. And I will continue to fight, to claw, to scratch, to do whatever it takes to get the right people on our team to give you the life that you've earned and that you've bestowed the trust in us to give you what you want financially. With that in mind, don't forget to look out for these upcoming emails for the Las Vegas seminars that we're going to be doing. Also, go on to One Wealth Map. And by the way, for those of you, thank you. You motivated me to get back on YouTube. I kept getting these emails and I was like, man, I am just so busy. I do not have time to do these. So under overwhelming request, if you go and you look up One Wealth Map on YouTube, there's now 79 new videos. And you know who I'm talking to, because there's about a handful, about 20 of you that kept saying, I like being in touch with you and hearing what you guys are doing for me through YouTube. So those are back on there. So again, go to YouTube, onewealthmap.com, One Wealth Map, I guess it's just hashtag One Wealth Map. And we'll see you on YouTube, and hopefully we'll see a bunch of you there in Vegas. Hey, have a great day.